Thanks for tuning into Talking Point. I'm your host, Niraj Shah. The case for a chat today, well, you can't have a conversation with a market veteran without talking about what's happening at the public sector end of the market. Almost any given day, and today is no different. So we will talk about what's happening for the key themes overall and within the PSU segment, maybe going ahead for 2024. Our guest yesterday enlightened me about the kind of outperformance that PSBs have had over the past, not just 1 year, but maybe 3 years and 5 years. So that's the second point of conversation on the case for a chat. And the second point that we will talk, of course. And needless to say, when it comes to, we talked about multibaggers in midcaps, but when it comes to having Sridhar Sivaram of Enam Holdings, we shouldn't and we cannot escape a confluence of macro and micro conversation. So I'm going to start off with that. Sridhar, so good having you. Thanks for taking the time. The pleasure having you. Sridhar, can't let you go without talking about what did you make of the budget, simply because in some sense, so much was anticipated around a few moves that could have been made, were not made, and the market gave a bit of a thumbs up, albeit a bit delayed.
Yeah, so I think 5.1% fiscal deficit. I don't think even the best, whoever was the most bullish on the finance minister was expecting it. And I think the trajectory for 4.5 for next year is very much on the cards now. I think the path is looking much simpler. There was an expectation that some of the subsidy numbers will be much higher. On the contrary, the subsidy numbers were either flat or lower. So we would have expected some extra spending before the elections, and that's not happening. And capital expenditure, which is the other number which one would look at, is anywhere between 12 to 15%. What number you take? If you take the revised budget expectations for the current year, then it's around 15%, which I think is very good given that it was up 30% last year. And they almost spent almost 90% of that, almost close to 950,000 crores is what the revised budget estimate is talking about capital expenditure from the government, which I think is very commendable because many experts believe that they will not be able to spend so much, and they have actually done it. So I think I would say 10 on 10 from on all standpoints. That the absolute fiscal deficit number is also down, which was one of my concerns in the previous budget, because that determines how much you borrow, not just the percentage, because your denominator is going up, but your absolute fiscal deficit is coming down. So your absolute borrowing number is coming down. So it's like really good on all front, and not expected that this would come in an interim budget. And I don't see this change if the government continues, where probability of that is very high, that they will change this too much. So I would say it's very good. In the past 3-4 years, transparency from this government on budget has significantly gone up. And I would like to thank the finance secretary also for that. I mean, they have actually gone on record to say that they will clean up, and they have done so.
Yeah, most certainly. Just a word on the capex part, because that has got significant implications for what markets do as well. One thought that came in, and Pranjul Bhandari of HSBC mentioned this, that the real story of FY24 has been state capex, because that has been really strong, and maybe that gives the ammo to the central government to maybe take the foot off the pedal. One, because state capex is happening even if private capex is not. And two, I think both the finance secretary and the finance minister in an interview to us mentioned that the absorption capacity also needs to be taken into account. We just can't keep on announcing a higher number when it's not getting absorbed. Are you sanguine on capex, and do you have any views on when private capex picks up?
So I actually last week made a presentation to a bunch of investors in the US, and one of my slides was a country under construction. So if you just go around, not just Mumbai, you just go around, and I travel a lot, there's so much of construction work that's going on top of what has already happened. Roads, airports, bridges, a lot has been done, and a lot is being still done. So I would say that this is what has happened, which is the capex number that we speak of. And we have to keep in mind that when the government says that capex is 10 lakh crores or whatever that number is, on top of that, there's a leverage. So actually, if you see what is happening in Mumbai, I think the government puts only 10 or 15%. The rest is all multilateral agencies giving you loans. So in our case, it's Japanese and German, counterparts giving us loan in very favorable terms. So there's a multiplier that the government puts in. So if the amount is, say, 10 lakhs, the actual capital expenditure is possibly 8 to 9 times of that. And that is what is making a difference, because India is a very favorable destination right now for a lot of global multilateral agencies to fund capital expenditure. And given that, I think what has happened is that private capex, for whatever reason, hasn't really picked up to the extent it should have. And I think even the government will feel disappointed that they did give a lot of swaps. In certain pockets, it has. But what had happened is in the previous term, a lot of the capex came in bulky, power sector, where a lot of capital went. This time it is more in granular, smaller, pockets, like say PLI given in the EMS sector. We are seeing a lot of activity there. In solar and wind, we are seeing activity, but they don't guzzle up as much capital as it is for the thermal. So I would say that a lot of this may change post-May. And the finance secretary also made a comment that they expect private capex to pick up second half. So I think second half and maybe next year we would see significant increase in private capex also.
So couple all of this with the valuations that we are sitting at and with what our EM neighbor is undergoing through. What are the investing implications, Sridhar?
So one, I think I've been saying this for a while, that I think EM as an asset class is dying. For almost 17, 18 years, EM as an asset class hasn't given any return. This I'm talking of dollar returns. And I've, in my previous avatar, have spoken to many pension funds, have presented cases for India and EM. One of the things always comes out is asset class doesn't do well for about 5 years. Most people absorb it. But after 10 years, it's a serious red flag. And now we are almost 15, 16 years, we haven't seen. And even within EM, only 2 countries have actually given any serious returns. One is India, the other one is Taiwan. So this is my point, that the EM as an asset class is not homogeneous. It has, countries which have per capita of $35,000 and $2,000. You have current account surplus countries and current account deficit countries. And you have commodity exporting and importing countries. So the benefit of one negates the deficiency of the other. So the sum of part is 0. And that's what shows up in the index, that it hasn't given any returns. That is one of the reasons why I see a lot of FI outflows. That despite India doing very well, the asset class is not doing very well. And I think that's my concern, that so a lot of people are now talking about EM ex-China or Asia ex-China. Maybe once those pick up, because China has their own issues. I'm not an expert on that. But that country hasn't done anything for even almost 17, 18 years also. So it's quite a shocking number.
So if that participation stays lackadaisical, do you think Indian markets, from the valuations that we are at, could still give a meaningful performance on the back of domestic flows and flows that niche players like you, for example, might be getting? Because when you go out and talk to investors, it's more convincing as opposed to do a passive investment per se.
So I think that the domestic investor has really picked up. So if you see, some of the research analysts have spoken about the 401k for India, which is the pension funds investing in the markets, and then the entire mutual fund industry, which is now, say, 50 lakh crore or 50 trillion, and almost 30-40% is equity out of that. And that is continuously growing. So almost $30-40 billion of domestic flows come into the Indian market, which is able to absorb any selling that comes from the FIs. If for whatever reason emerging markets stabilize and then flows start to come, India will definitely get disproportionate share. Keep in mind, India's weight has almost doubled in the last 3 years.
Right.
We're almost touching 18% index weight. We used to be in single digit, 8-9%, say if you go back 3-4 years. So index weight has also gone up. So India is getting flows based on the index weight in MSCI, but the overall asset class is shrinking. So that is the larger concern, I would say. But I think the domestic flows is a big story, and that is possibly has held us very well despite FIs selling. If you go back, say, 2 years back when FIs had a massive sellout in India.
Yeah, because remember, I'm sure you understood this, but just to lay it out, the MSCI EM index, a basket of countries which have weightages, and what Sivaram is saying, that India's weightage in that index has moved up from single digits, which is 7, 8, 9%, whatever it may have been a few years back, to nearly touching 18%. So when passive flows come in and they say that let's allocate to the EM basket, 18% of that 100 rupees or $100 would go to India, passive money, which is hitherto not been very, very strong.
Plus active also. So
Active
for active also, if 18 is the benchmark, then I have to be plus minus 18. So earlier I was 9. Even if I was very positive, I'll be 15.
Right.
Now if my benchmark is 18, at 15 I'm underweight the country.
Right.
So I need to be at least 20, 25 if I'm positive. So it works both ways.
Both ways, yeah. And because fund managers have to outperform the benchmark at the very least, if nothing else.
Exactly.
Okay. Sridhar, just one question before we take that break. And because you speak to so many global investors, what are they waiting for? Are they waiting for EM to stabilize for putting money into India? Are they still not making individual idiosyncratic India bets? What's happening and what is it that they're saying? When would they, are they comfortable with the valuations or would they wait for a valuation pullback?
So I think country-specific calls, large pension funds don't want to make. So when I speak to my friends who run India-dedicated funds, they are not seeing disproportionate allocation vis-a-vis how the country has performed from an index standpoint. If you compare India versus China over the last 5 years, there's been a massive difference, almost like 20% CAGR difference, which is very massive. But I think the reason is that countries are in flavor of the year for a period like China was. We know what happened to Russia. Literally, people had to write off to zero. Similar issues happened with Turkey. So within emerging markets, I don't think pension funds or large investors want to take a specific country bet. They're happy taking a regional bet or a asset class bet because that seems safer for the person who makes the asset class. I think it may change over a period of time if India continues to outperform the way it is doing. Also, global asset allocators haven't really allocated as much capital to India as they would have to China. But now that the index weight has gone up and the buzz on India is also far higher, I think that may change. And I think the valuation argument to a large extent, India's pockets of both valuations, right? I mean, you have very high PE stocks and you have low PE stocks also, and you have somewhere in between. I mean, our financials are no longer where they were. I mean, you can't call a 2 times price to book, which is 1 standard deviation or 1.5 standard deviation lower than the 10-year average, as expensive for some of these banks. So I don't think it's a valuation argument anymore.
Okay. Hold that thought, Sridhar. We'll take a quick break, come back and talk more about specifics with Sridhar Sivaram of Inam Holdings. back with Talking Point in conversation with Sridhar Sivaram of Inam Holdings. Now, Sridhar, we left off with you saying that it's a tale of two halves. Some of the halves are not that expensive. You mentioned financials. I want to draw your attention to that, something that you mentioned to me as well.
Sure.
Not just currently, but if you look at just the period of outperformance or what's led to these valuations, the last 3 or 5 years, as much as we like to berate public sector units, PSBs versus private banks, let's start off with that and move to the other PSUs.
Yeah, sure.
There's a bout of outperformance by private public sector banks. Now, what do you think one led to this? Did you also preempt that part one? And what's next now? Because after such a long period of underperformance and such good valuations relative to history, do private banks bounce back?
So I think we were quite lucky. I mean, as I've mentioned this in the past, that sometime in November of 2020, we had a call with the chairman of one of the public sector banks because they were doing a QIP. And we actually jumped into the call only to understand, how COVID is impacting, and the government had announced some credit guarantee programs, how that is playing out. But as the conversation went, we realized that their market cap was lower than their pre-provision profit by a big margin. I mean, normally market cap to pre-provisions are in 2, 3, 4 times, and they were like at 0.6 or something. I mean, they were so absurd that, we just kept the call. It was a one-on-one call, but we just figured out that the valuations were really absurd. And then we checked all the others. And we said that, this is really out of sync. And honestly, I never thought that I will be, jumping into buying a PSU bank. But very early in my career, some of my earlier bosses had always told that whenever you get into a meeting, keep an open mind. Don't have your biases. We all have our biases. I mean, PSU banks have not delivered returns for decades. But, every meeting you go with a clean slate, not with biases. And sometimes you learn it the hard way. And those learnings did play out here, that we did jump into it. And then we looked at others and we saw the same absurdity everywhere. Hand on heart, did we expect that we'll still hold on to many of those for almost now 3.5, 4 years? No, we didn't, but we are still holding because the earnings have outpaced the market returns. So if you take the earnings from, say, FY21 and what they're delivering now and see the stock price returns, the earnings have outpaced. So they actually got derated. So it's a shocking number. In fact, I knew on the back of my hand that this is the case. I recently did the numbers to see, and it's shocking by a big margin. So they've actually outpaced the earnings by a big margin. And I think one of the big reasons for the outperformance in earnings has been credit cost. So the credit cost on an average used to be about 2% for most of these public sector banks. The last number for SBI would be 0.2. Now, I think it can't go any below than this. I'm just giving you an example of how credit cost has behaved. And as Mr. Kotak said, this is like the Cinderella moment for the Indian banking industry, that everything is falling into place. People are paying in time, and many of the PSU banks had provided so much that they have a lot of cushion. So one of the reasons for the outperformance is that the environment was benign. They were shifting from a focus more on corporate to retail. As a result, the NIMs were improving and the credit cost was falling. So I would say this was the broad framework. Private sector banks didn't have the cushion of the credit cost falling because they were already very efficient. Whereas these companies are now becoming more efficient. And when I meet some of these PSU bank chairmen, I do feel that they are really good. I mean, the discussions that you have with them, it almost reminds me of how HDFC Bank used to be before. I mean, they want to provide more. I mean, in most of the cases, I can tell you that if they want, they can show far higher profitability. And they keep telling me, sir, aap sara profit ek quarter mein leke kya karoge? There is uncertainty ahead. There's a change in regulation. We want to have some cushion. I mean, the discussions are at a different level. So that's how I would put it, that there is a method to the madness. And we think that selectively it may continue for some more time.
Okay. But where does this leave private banks, for example, I mean, one of the largest lenders available at valuations that it has never been available at for the while. I mean, I'm talking about HDFC Bank, but some of the others too, they haven't gone anywhere. So now, is there fundamental reasons that are changing for the performance of the private sector behemoths to also change from what it has been in the last 12 to 18 months?
So I think one of the reasons for private sector banks to have not performed comes from the fact that emerging market as an asset class is not doing well, and FIs are selling, and this is a heavily over-owned sector in the FIs. So if you see the FI holding in some of these banks are structurally coming down. So it comes from the original discussion. Plus, I think some have had, say, structural issues because of merger or whatever, which is behind us now. Plus, the RBI's liquidity position isn't also really helping the case for banks in general, because there's a scramble for deposit. I mean, you speak to any bank chairman or CEO, he'll tell you that deposit is the big issue right now. The asset side is not the problem, the liability side is the problem. I think that may change. We'll see what the RBI governor says in the policy tomorrow. I think maybe it's, I would say, 1 or 2 quarter issue. I would still be quite bullish on the private sector banks also, because they've reached valuations which are looking very good. Maybe 1 or 2 quarters of pain because of the liability side. But structurally, I think if the economy were to take off and we see private capex coming back, we think these banks will do well.
Okay. We have time for one more question. Either PSUs at large, or what does appear attractive to you now that where we are sitting at, and I heard you mention that not everything is expensive. There are some good pockets too. So non-banks, maybe there are others too. So what do you like?
You're saying in the market in general?
At large, yes.
So I think the power sector looks very exciting. I mean, this has been a sector which has been ignored for a long period of time. I would say everything in the power sector is looking good. Even the thermal side is looking good, because India is underinvested in thermal. We are literally hitting peak capacity every day during the peak hours. So we are seeing companies scramble to put more thermal. We will double our wind capacity in the next 3 to 4 years. We'll triple our solar capacity in the next 3 to 4 years. So in the ecosystem, there is lots to play in this. So I'm saying in the entire power space, be it thermal, wind, solar, there's lots to play, because the government is also playing favorably, which is they also want the commitments that they have kept globally on moving green. They want that to happen. So I think this is a space to be watched out, and entire ecosystem, I mean, individually people have to figure out what is to be played, but I think this is a space which we remain quite bullish on.
Okay. Sridhar, always a pleasure talking to you. Thank you for combining the macro and the micro both. Lovely talking to you today.
Thank you. Thank you for inviting.
And viewers, thanks for tuning into this edition of The Talking Point.